Hello, good morning, everybody. Nice to see there is still few people, diehard or survivors from all the parties of these days. So I'm pleased to introduce our speakers. So we have Mia Drennan, founder and CEO of GLAS. GLAS is probably the world's premier independent provider of loan agency and trustee services. We have Yuval Golan. Founder and CEO of Waltz. Waltz is a fintech, proptech, wealth tech startup providing foreign investors with remote tools on investment on US real estate residential assets. Then you can introduce better yourself. And then we have Victor Alexiev from Citi. Victor's team supports asset-backed securitization financing at Citi through venture capital investments. I'm happy for you to introduce yourself a bit more, Mia, if you want.
Yeah, but this is actually my 25th attendance at GABS in Barcelona. So I can't believe I'm actually celebrating a quarter century. I started, my previous job I was working, my last job was running corporate trust business at Bank of New York. And then I started GLAS 15 years ago. And we are now the #1 independent global agent and trustee, administering nearly 850 billion assets under management in 11 countries and 15 offices around the world.
Yuval.
Hi, everyone. Yuval Golan, founder and CEO of Waltz. Lived in 9 countries. So was an immigrant in many places, and every time started from zero when banks and regulators looked at me like I'm some armament dealer or something like that. Realized there's 20 million people like me that move around the world and can afford buying a home. And in our professional lives, we're busy, but our personal lives, we're lazy misanthropes that wants to have easy access to investment. So we built a platform for the largest residential real estate in the world. So any foreigner and a local can come in, set up their entity within seconds, a US bank account within minutes, do their foreign currency exchange, get their loan, get insured, and have a passive real estate investment while we also originate a loan and sell it to the secondary market. So it's a fully consolidated from the user experience. And for the ABS, it's a perfect buyer that never goes delinquent because they can afford multiple homes and the rating agencies don't know how to look at them.
And I'm Victor. I'm responsible for one of Citi's venture investing platform. We are embedded in our financing and securitization business and invest in fintech lenders, proptech companies, and infrastructure businesses that fundamentally support those and the flow of credit. And the thesis is relatively simple. We're looking for differentiated, high-growth, tech-enabled businesses that could become clients of the bank or the ecosystem of clients around it.
Very good. Mia, let me start first with you with the question. Fintech has been talked about for years, and effectively, what has changed in the securitization world, or effectively in the markets, in your view, and what has been really making efficient for the market, and what is still inefficient for that? So, what do you think is still things to improve, or things that will not be improved?
Sure. Well, I think back to that sort of 25-year journey where I was in previous times. We were sort of all about, asset-backed securities, CDOs, all of those very complex structured credit transactions, and people like myself, paying agents, trustees, cash managers, were using spreadsheets to basically provide reporting and information to their investor clients. There were some technological developments, things like Wall Street Office and other platforms, which started to make those products more efficient. But I don't think the advancement in the technology has been as quick as we would have hoped in that gap. So a lot of those big platforms that still support those kind of products still exist today. We use one, which is definitely a sunset system. And ultimately, we've done a lot of development work to make the reporting a lot more efficient. However, with an eye on now evolving into a fintech, because really it's all about data. transparency, and having the ability to have a platform which is providing instant information so that you can make liquidity efficient. So it's really about many small companies evolving, and there's quite a number here who are actually taking the opportunity to really bring technology to the forefront now to make much more efficiency in the credit markets.
Thank you. Victor, let's talk about global investments in the fintech world. For what I read as a lawyer, I think the investments in 2025 increased after several years of not performance, even though deals numbers are still a challenge. So I would like to know what's your view in terms of global investment, whether you feel that the appetite of the investors for fintech is increasing, and what are effectively the risks for investors and startups they both have to manage, in particular in these current scenarios of geopolitical uncertainty, risk of potential recession, concern about AI bubble, all this stuff. So
it's a pretty big question here. Okay, so first, to simplify a little bit, fintech globally, obviously, there's a lot of stuff going on, and there's flows going into different areas, be that infrastructure, payments, etc. One of the areas that's most isolated, I would say, from interest is lending. As in traditional VCs look at a lending business and say, this has a balance sheet, it has like stuff going through that I don't like, it's not pure software, get it out. So actually, while you saw increase maybe in AI-enabled financial service technology or in payment infrastructure, the lending side went down a bit, which is great for the likes of us because we have our pick of the litter, and also for many other credit funds that have started building equity investment arms to support some of their business and get closer to the originators. Enter AI. One of the things that is very good within fintech lending is because of the legal structure and because of the fact that the data pipes fundamentally have not been built yet, it's a relatively isolated space, as in there's a lot of opportunity. AI is a great enabling factor, but it's relatively protected from what people call the SaaS apocalypse, which is basically is wiping out a lot of equity value from the markets. Now, of course, there are many companies that obviously have, after the several blowouts, I'm not going to list them right now, but everybody knows why this time of the year, last year, seemed to be a little bit more upbeat than now. But after that, there was a big realization that, we've grown up from a cottage industry 15 years ago into something that's a $3 trillion market. Maybe we shouldn't run it on spreadsheets and CSVs. And so infrastructure comes in, which is the data pipes that we're talking about. So that part is very interesting. And I think VC specifically is investing more heavily in that infrastructure layer rather than the actual asset formation or capital flows. And to your last portion of the question with regard of geopolitics, it definitely complicates things. We have, for example, been tracking several companies in the Middle East. It's very hard to convince my risk and compliance partner that that's a good idea right now, especially because you don't know where this is going to end. You also don't know how much more pain would the market absorb, because despite the current situation, the good ones of these companies are able to rebalance their portfolios and refocus their direction in a way that actually still provides growth for them. But you don't know where the floor is going to fall off. Yeah.
What about the risk of potential recession? Is it something that you do consider in investment from fintech, or it's just like
for sure
something that you
for sure, which is also one of the reasons why we focus on first of all anti-correlated asset types in order to build out our own portfolio. But the second thing is we've kind of stepped away from the traditional, I would say, lending experiences like BNPL, like SME, and I'm talking about Sprint as an investment vehicle. I'm not talking about the bank. So things that are more plain vanilla and or have kind of less resilient needs attached to them, we've pulled back in order to balance. But obviously, we've been in the market for like 8 years now, which means we have a portfolio of 40 companies plus that have been,
attached by that, yeah.
Correct.
And what about the potential risk or the concern about the artificial intelligence bubble, or things that will? Before there was a panel on AI, it was quite interesting.
Before working for a bank, I was purely in tech, and my background is in applied mathematics and software engineering. And I think obviously there's a lot more to it than we give it credit, but there's also a lot of misunderstanding on how the technology works and what it actually does. So I'm not as worried. Obviously, there's going to be a massive restructure in terms of how we do business and how we get paid for that and who actually gets paid for that. But I think that I'm not as worried as others.
Okay. Thank you. Yuval, coming a bit for you and what Waltz does. How do you think fintech improves underwriting from a global perspective? And if you can also share with us if you have any data or history track on that, and what's what you're doing with your company in terms of that.
Sure. So I'll also add to a colleague here, Victor, that just explained a few things that are very fundamentals in the industry. So I want to jump through VC, AI, underwriting, data, and ABS, which is very important. So I can make a very sarcastic joke, and I've been doing this for the past 2 weeks, and I said to many of the engineers I work with and the technologies and the amazing product people, I said in lending, there's 2 types of people. There's the operators who are extremely wealthy, and there's the tech engineers that think they can change the industry that usually go bankrupt. So these are the 2 types of people. Now, if you look at this room, this is an ABS conference. Lending has started, I don't know, it's from the days from the Medici. Yes, we added Excel, we added some other stuff, and AI and a lot of things. It has not changed, and it's only growing. It's a balance sheet business. Wow, very scary. But at the end, when you give a loan, especially in our field, and then I'll jump back to why VCs are afraid of, and there's a bunch of reasons. When you do asset-based lending, at the end, it's a second-grade elementary school formula, speaking about mathematics. Denominator is rent income, or your ability to pay on a monthly basis. Denominator is your expenses. And then you take that moment and you freeze it in time, and you assume for the next 30 years this doesn't change. So if today you work at Citibank and tomorrow you become a ballerina, it's irrelevant. For me, the same. So this is how you look at it. And when you look at rental income, it's much better because any fluctuations might take effect. But at any crisis, guess what? People sell their homes, they go to rent. It happened in 2009, 10, 11. So take all this data. Now, balance sheet business, any of the businesses you see here in the room, how long did it take you to build your amazing company?
15 years.
Yeah. So VC want to get return within 3 to 7 years. This is what they promised their LP. ABS business, maybe 10, 50, I know. But they tell them, I know, exit very quickly. But at the end, all the companies for lending business, and sorry, it's a long answer. I want to give context to people that are not familiar, that their VCs pushed them for hockey stick growth. Usually the hockey stick flipped, and then it went down. And there's 2 examples I can give, like 8Fig, Stoa. They did all these things. And then, oops, we checked the books and we checked right?
Any form of forced growth on a lending business means you're eating the crap from the bottom of the market.
Correct.
And that's never a good idea.
Exactly, and that's why it's not a VC business. The issue is in growth, until you reach that break even or significant ant moving to giants in the room to be looked at, that's the death valley between seed to whatever. So take all of that at the end. Data points that now we have with AI, if the right humans define the rules and look in detail of all the moving parts, which is compliance, regulation, underwriting, securitization, then take all the 5,000 documents and anomalies and governments and whatever and compare them. Then have an eye that checks them, not 5 p.m. after 500 files and anomalies. And then we use this data to look at people that have high credibility, that work at different countries, that in the US, because the market is not built for foreigners, just like in the UK or Italy or Israel, it's not incompetence, it's just we're irrelevant. And you take the people that can afford the most and you give them a rate based on the second grade formula I just mentioned.
And I think,
I was just going to add, I mean, I totally agree with everything you just said. In my view, in terms of sort of tech advancement as well, you know, the other thing is really about the payments. And I think that, you know, this is where there's a challenge, because no matter whether you're moving into a fintech, going through transformation, the payment side, when you're moving billions of dollars, is still very, you know, manual, and there's not a huge amount of change in that technology today, because I think people still want humans in the loop for that.
And I mean, question for all of you, because I mean, I think that the discussion is more interesting. How do you see the current increase in regulation, especially I would say in the US, been signing of the Genius Act, in Europe as well, there's been legislation going. How do you think will affect, will be positively affecting, you know, the market, the, you know, investors and the startup, or do you think they will somehow create some imbalance in that respect?
In the evaluations?
In valuation, you know,
So I think Victor explained, and the AI is everyone's excited about it, but at the end, just like in 2021, 2023, when interest was very low and people were throwing money at stuff, we have to see how the unit economics makes sense and how businesses make sense and if they become profitable. For us, I can tell you, we went through terrible times. So we raised our A round during the highest peak of interest rate, the fall of fintech, the crush of prop tech, the crush of lending businesses.
Metaverse?
Yeah, metaverse. And
yeah,
now with AI agents, you have all the experts, they tell you, oh, but AI can do it all. And I say, guys, I think all these people here are not AI. And at the end, deals are being closed in private rooms and relationships. Why would I put my 30-year reputation on someone that says they have technology that I'm not sure is validated? So that's number 3. And number 4, when you build a robust business the right way, and the underwriting, the tech, the technology, it comes on top. The foundations have to do not depend on legacy systems that someone else's bugs relate to you, and then you fix another patch, another patch, another patches. Understand do everything on your own, learn it, learn the risk, go visit the home, speak to the borrowers, see what it is, learn the risks, and build around it a tech business, because at the end, this is a tech-enabled business. It's not tech-first business, and this is what is kind of how I take a look at it. And at the end, once they realize, again, the VCs, with AI, without AI, this is a 50 trillion market in the US alone, without all the ancillary services. There's no TAM. So if someone says, what's the TAM? What are you looking to have? I want to be the leader number 179 with only 0.1% of the market. I win.
I think we can't underestimate the changes involved in a business when you're thinking about the use of AI. So, you know, as I said, we started our business 15 years ago, and it was really about how do we offer white glove service to a growing global client base, and particularly around complex transactions. Probably for the last nearly 10 years now, we've been working on tech enablement and transformation. Predominantly to provide much better reporting to our clients and to deal with things like ABLs and so on. So it really evolved from there. But obviously in the last probably 12 months or so, we've been really focused on how do we become an AI enablement company. Number one, for efficiency in the business. But, you know, you have to kind of reimagine again the whole business. You have to reimagine the procedures, the processes. You have to understand what you're doing today to create new ones. You also have to kind of start fostering a culture of a digital mindset, which I think in an organisation like ours, which is, you know, fairly agile, is something that myself and my team are working on, but it's certainly not easy. So if you think about in our ABS and the credit markets, the complexities, the deal parties, the stakeholders that are involved, we are a tiny part of that market, and we're at the front leading the change and the transformation. We're looking at where we put agents and how we deploy them in the business, but we can move quickly. I believe that a number of other very large institutions are going to, they don't know where to start and how to make those changes. So it's going to be a very interesting journey over the next 6 to 12 months, because whomever gets there first is going to be the winner.
But Mia, from what you said also before, I guess, artificial intelligence is keen, but at the end of the day, human will be still, controlling it, or will be probably still, the most important part.
Absolutely.
And as Yuval was saying, at the end of the day, business will be carried out by, persons rather than.
Absolutely. I think the thing is as well, let's just take it. A contract comes through from a law firm. And so ultimately, that to me is quite an easy no-brainer, right? In terms of legal contract to be digitized. But people still want to go to law firms to get opinions. And deal with humans. As I said, when I look at the other end of this, no matter whether you have a straight-through processing platform or not, the clients we work with, which are some of the biggest names in the market, when we're going to go a closing on a huge acquisition, Anthropic last week took a 30 billion investment from Apollo and Blackstone, I believe. And ultimately, that payment needs to go through on time, right? And they need to make sure there's a human in the loop. So just a few examples of where I think AI can be helpful, but it's certainly not going to be the thing. The agents are not going to be running those big transactions.
Yuval, I don't know.
So I think, just to clarify, I think humans will be overseeing and more efficient with the technology that we see. And of course, some industries will be totally crushed that we see already right now. But like in the financial business, sometimes we as financial institutions want to move very fast, but the regulators don't.
Yeah.
So there's always a lagging, and how the implication of those things come from the other side. The thing we implemented, what are the breaches? How do we protect ourselves? It's always the consumers too, the poor consumers that don't know how to read, the poor consumers that sign a contract and don't want to fulfill it, they don't pay it. Oh no, oh no. So it's a lot of these things that happen.
Victor, one question. How do you think Fintech has driven the growth of private credit, if it has, or how do you think it can do that?
You can think of it as oil rigs, all extraction rigs, right? So, if you first, I think the first step is probably regulation drove the growth of private credit because it pushed out the banks.
Yeah.
But then all of a sudden, once the low-hanging fruits are gone, there's a question of how do I reach a lot more people or businesses at scale? You need technology for that, otherwise the cost benefit doesn't really work. And the second question is, how do I describe or understand the cash flows that I can sweat from specific assets so that I can turn those into ABS, right? And that's where technology obviously helps, because instead of selling you dreams or basically lying, I can fundamentally have verifiable data that tells me how a certain cash flow behaves, what are the obligations around it, the constraints, etc., etc. And back to the question on AI, I don't see us as some form of agent shepherds, going and grazing the agents on the fields. I think that the fundamental difference between a human intelligence and an artificial intelligence is the fact that the artificial intelligence doesn't want and doesn't know what to want, which is also why I go to my lawyers, because I need to be able to ask them,
What do you want? What do you want?
What should I want, and is what I want really good for me in the long term, right? And I need someone to explain it to me in a way that actually, takes out the complexity.
Is that not what Claude does? Is that not what Claude does, though, if you ask it what you want?
No, it just gives me some,
Some input.
some
I
verbiage.
heard it's a therapist now.
Yeah.
One of the things about Victor, for you on global investments, what do you see, as main drivers in this year and the future years and also consider what we said before about the regulation, the enhancement of the regulation.
Yeah, I mean, I'm not gonna pretend that I have some like magic crystal ball that can make me get. If I did, I'd probably not be working for someone else. But the things that I'm very curious about specifically, there are things around. So there's a lot of interesting things happening in the equipment financing space, particularly industrial equipment. Obviously, Europe and other parts of the world are reindustrializing, which means that a lot of capital has to be deployed there. And I think the mental model has shifted more from ownership to access to assets, as in I'd like the performance, I'd like the ability to use the asset, but I don't really want to keep it on my balance sheet and service it and etc. So there's a lot of opportunity into that space, which is basically the ownership to access in the industrial equipment space. GPU financing around the data center financing is an interesting one, mostly because you need to be able to establish resale price or essentially a bottom. So I see a lot of interesting tech companies essentially building stuff in that space. So curious about that space as well. For Europe in particular, in certain parts of Asia, later life lending. So those are equity release, reverse mortgage, etc. Done in a humane, responsible way that doesn't get us back into previous regressions that the market has seen. So that's something that I'm definitely curious about. We've also been developing a thesis around creator economy because it's funny how a multi-billion-dollar industry that's currently challenging Hollywood, it has like a handful of credit card type products to finance its production of content and talent. So just a few examples, maybe.
And what about asset management? Is something that you'll be considering? I know asset managers are now trying to leverage on the.
No, we have curious conversations, but I wouldn't veer into providing answers that I don't really understand that well. I think what I am most interested in that space, or the only thing that I actually understand properly, is the build out of infrastructure. So those are, again, the data pipes, the reporting, the agency automation functions, etc., that are needed, because a lot of the asset managers and credit funds fundamentally operate on technology that's like 20 years old.
No, yeah. Understood. So final question for all of you. It's really how you see next for fintech on the structured finance world, how you see the future. I mean, you've already said before 6-12 months. Is it that short or longer period? Are you see next year talking here what will probably be the new narratives in terms of the fintech and what we have seen?
Okay, I mean, I think look from GLAS's perspective, we're a mission critical business globally now, supporting a huge amount of institutional debt across all different asset classes. So we've been very focused on how we transform our business into a fintech. I think, look, the most important thing we hear from our clients is data. Because ultimately, whether you're, there's the private credit market has been very, very, very opaque. And so quite interestingly, we do a lot of work in the bankruptcy space as well as performing credit. So I think getting transparency around a lot of that data is going to provide lots of information for creditors and ultimately CLOs, ABS, ABLs, etc. So there is a move, and there's a lot of companies here that are starting up, trying to disrupt that space or writing code to disrupt that space for people to buy. I think the biggest challenge is I don't necessarily believe the industry is ready for it yet, for the reasons I gave earlier. So some of those companies, well, how are they going to be able to grow and expand and go to market and become a global business? So they're going to have to think about partnerships, JVs, acquisitions, etc. But I don't think in a year from now when we're here, we will be replaced by agents talking on the screen or Claude or chat. I think we'll still be having similar conversations about the same challenges, although there'll probably be some more transformation in the space.
Yuval?
So on my end, I think that the large institutions are adopting Anthropic and they're signing big deals with them to try to see what they can move or help them out. So it moved from the consulting companies that consult them on AI that they actually bring the AI in-house. But again, I'm not a corporate guy, don't know how decision making is happening there, and the processes and implementation. For our side, data was always the infrastructure. The borrowers have a lot of data. The processes are very fragmented. The idea is to consolidate the data in one way that takes all the compliance and complexities to give the client an amazing Amazon experience. This is what we've been focusing on in a very nice way, an experienced way, because why we see the client movement into easy instant services is like, I'm busy, I need time, I want not to be treated as a nobody, I want to be seen. So the consolidation of these things would happen. And then the third part, there's a lot of small startups that were very niche, just like SaaS that grew very fast. So I think there will be an era of finally consolidated businesses. So I lived in Asia for 10 years, and when WeChat came with that night on Chinese New Year, and they introduced money payments, I was like, okay, we're gone. The government knows everything, payments are everywhere. This is the most consolidated winning system of all. This is the Sauron of everything. So consolidated system that built the infrastructure right and grab the client and say, hey, we offer you everything from all areas, will create amazing competitive advantage. And the user will say, awesome, I don't need to go through 17 apps. Yeah. So this is how I see it. The next year, another panel, and we'll talk about some examples
of concentration.
And then we need someone from a big company to tell us how they're implementing AI.
Victor?
Yeah, I mean, I don't know. I think, in general, my learning from 2016 is that during a Trump presidency, you don't really make predictions about the future.
Which is fair.
The three things that I expect are probably, one is, I think we're going to see more and more the fin parts become invisible, as in more of the, like you don't want a loan. You want to buy something and then you want to find a way to finance it or fund it, but you don't want to go to a place and request credit, right? So more of that flow is going to be embedded, more of that user experience is going to pull away and focus on what you actually want to do as opposed to, how you get there. The second thing is, and I've seen this year after year, I think on the first ABS that I joined 4 years ago, there was like 0 companies that were talking about on-chain, and this year it seemes like there's a lot more. So I'm seeing a lot more assets and a lot more activity move on-chain through stablecoins, because I think the messy bits seem to be behind, and people are starting to figure out, okay, here are the components that are actually useful, and shamelessly embedding them in their systems. And to the on top of the two things, the third one is basically new players, new kids on the block, new funds, but completely new rethought approaches to the universe will emerge. And so I wouldn't be surprised if like 30% of the names that we see around here are actually people that we didn't really have
known, and they will come.
Yeah.
Thank you. From the public, there's any question you want to ask to the speaker? I don't know if there is someone. I'll come down.
Thank you. Super interesting panel. It's fun to see innovators here in a conference which is a bit, more established. So I have a question about AI, of course. We always talk about the human in the loop, and I understand that to close deals we have to meet people, especially the bigger deals. But in many cases, when we say human in the loop, we're talking about a final decision maker being a human. And in many cases, at least I find myself just click, 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 and okay, I'm the rubber stamp in the loop. How do you avoid this kind of thing in your businesses?
I think we're still fairly naive. It's not the wrong word, sorry. We're still very early on in our journey in AI, and we're learning a lot about it. From a long-serving person that's been in this industry for a very long time, I think AI actually allows us to actually do more interesting work. And I think it's really incumbent of companies like us and others to really leverage AI with your workforce to create more interesting work jobs for people and opportunities, which is probably going to involve coming to lots of conferences, meeting lots of people and building those relationships and trust. So for us, we are an operational business. We're using AI to enhance efficiency, both internally and externally, but really to actually elevate our workforce to create much more meaningful day-to-day work.
So from us, it's twofolded. One is the client doesn't care. They just want a pretty screen. And for them, it can be trucks or whatever drives the business not to bother them. So as long as you create an amazing non-incumbent experience, which is easy for a 3-year-old to do with pictures, client is happy, which is most what Fintech started or other companies, just the experience. And then from the side of AI, the idea is you try to speak to all the humans in the loop and all their pains, not to ask them to be product designers, just to list the pains, ask what's urgent, everything is urgent, prioritize for them, and then build a system that is around same pictures for the operator. Because at the end, like when you look at Amazon, it's the perfect operator system. If you build a perfect operator system, you can build a perfect customer experience with more efficient people and detail-oriented. And that's how we use it in our company.
Like I said, I spent my whole career in tech, and I'm reminded of I think it was an interview with Will Smith. Someone asked him about his opinion on social media. And his response was, well, the big difference is that previously you could be stupid in private and nobody will know. Now you can be stupid on a global scale. So it's the same thing for me with artificial intelligence. You can be stupid and confident pretty fast. And that's a dangerous place to be. So I think that, to revert back, I wouldn't want to automate something I don't understand. A process or etc. And I would always want an expert to be the rubber stamp as opposed to rubber stamping things I have no idea the implications of.
Any other question from the public? So I'd like to thank you, the speakers, and I hope you enjoy our discussion and have a nice day.